The 2026 financial threshold, a major shift for seniors and immigrants. A significant transformation is coming to the American financial landscape in 2026, and it specifically targets seniors over 60, green card holders, and anyone not born a U.S. citizen. This is not merely a minor regulatory adjustment. It is a fundamental change in how the United States government monitors and enforces rules regarding foreign bank accounts. For decades, many retirees and immigrants operated under the assumption that small, dormant accounts in their home countries were beneath the government's notice. Starting in early 2027, when you file your reports for the 2026 calendar year, that assumption could lead to devastating financial and legal consequences. The Internal Revenue Service, IRS, and the Financial Crimes Enforcement Network, FinCEN, are jointly launching the Enhanced Foreign Account Mandatory Reporting System. This initiative moves foreign asset disclosure from specialized, often overlooked forms directly onto the standard Form 1040 tax return. For the first time, the government is lowering the reporting threshold specifically for these demographics, meaning accounts with as little as $5,000, or in some cases $3,000, must now be disclosed. This shift is designed to eliminate unintentional non-compliance, where individuals break rules simply because they didn't know they existed. As we begin this deep dive, it is crucial to understand that your financial transparency is now directly linked to your immigration security. In this new era, what you don't report can be just as dangerous as what you do. Breaking down the enhanced mandatory reporting system. The engine behind this massive shift is the Enhanced Foreign Account Mandatory Reporting System, a joint initiative launched by the Financial Crimes Enforcement Network, FinCEN, and the IRS. This is far from a minor bureaucratic adjustment. It represents a fundamental expansion of how the United States government tracks and enforces rules regarding money held outside its borders. Traditionally, foreign account reporting was often buried in specialized separate forms like the F-bar or Form 8938, which many average taxpayers and even some preparers rarely encountered unless they dealt with large sums of money. Starting in 2026, the government is moving these requirements out of the shadows and directly onto the front page of the standard Form 1040 tax return. By placing mandatory questions on the main return, the IRS is essentially eliminating the "I didn't know" defense. Every senior over 60 and every immigrant filer will be forced to explicitly confirm or deny the existence of foreign financial ties. This move towards radical transparency is designed to identify unintentional noncompliance, situations where honest people break rules simply because the requirements were too obscure. In this new era, your financial privacy regarding overseas assets is being replaced by a mandatory disclosure mandate that is now a core part of the American tax filing process. The massive threshold drop. Why $5,000 is the new standard? The most striking technical change in the 2026 rule is the dramatic lowering of reporting thresholds for specific groups. Under the current rules, most people only worry about foreign account reporting if their combined accounts exceed $10,000. However, the new system creates a two-tier reality. While younger, native-born Americans keep the $10,000 limit, the threshold for seniors over 60 and all immigrant filers, including green card holders and naturalized citizens, plummets to just $5,000. In certain sensitive cases, particularly those involving active citizenship applications or specific visa statuses, the reporting trigger can drop even lower to as little as $3,000. This means that a modest savings account in your home country, which you might have kept for decades for small family emergencies or travel expenses, now puts you squarely in the government's sights. Similarly, the limits for Form 8938, used for reporting specified foreign financial assets, are being slashed to $25,000 at the end of the year or $40,000 at any point during the year for these targeted groups. These new numbers are designed to catch millions of middle-class and retired individuals who were previously exempt from this high level of scrutiny. Redefining assets. It's more than just bank accounts. A dangerous mistake many taxpayers make is assuming that foreign accounts only refer to traditional checking or savings accounts. The 2026 rule aggressively expands the definition of what must be reported. Under the new system, mandatory disclosure includes foreign retirement accounts and pension funds from previous careers abroad. Even if you are not yet receiving payments, the existence of the fund must be noted. The list of reportable assets continues to grow. Life insurance policies with a cash value issued by foreign companies, digital wallets held with foreign financial institutions, and even prepaid debit cards from overseas banks. Furthermore, the government is now interested in partial ownership. If you own a small percentage of a family home or business in another country that generates any financial return, even if you never see that cash in the U.S., it likely needs to be disclosed. In short, if you have any financial tie, any asset, or any money outside the United States that carries value, the 2026 rules assume it is part of your worldwide taxable profile. Understanding this broad scope is the only way to avoid an accidental omission that could trigger a federal investigation. The end of silos, real-time data sharing. The most significant structural change for 2026 is the implementation of complete real-time data sharing between federal agencies. Historically, the IRS, the Financial Crimes Enforcement Network, FinCEN, and U.S. Citizenship and Immigration Services, USCIS, operated like separate islands, making it difficult for one agency to know what you told the other. That era of administrative blind spots is officially ending. Under the new system, your tax return, your FBAR filings, and your immigration records will be automatically compared by sophisticated algorithms. If you tell the IRS you have no foreign accounts, but a data sharing agreement with a foreign bank or a previous disclosure to USCIS shows otherwise, the system will generate an automatic notice. This interconnected web is designed to identify inconsistencies instantly. For green card holders and naturalized citizens, this means that every box you check on your tax return is now visible to the immigration officers who decide the fate of your citizenship or residency. The government's digital net is tightening, making it nearly impossible for unreported foreign connections to remain hidden for long. Why this specific target? Unintentional noncompliance. Many seniors and immigrants feel singled out by these rules, and they are right to feel that way. The IRS and FinCEN have openly stated that they are targeting these demographics based on multiple studies showing they are the primary sources of unintentional noncompliance. These groups often lead internationally mobile lives, retiring abroad, working in multiple countries, or maintaining deep ties to their nations of origin. From a senior's perspective, a small pension or an old savings account in their home country is just a practical convenience, not a tax evasion scheme. Many believe that if the money was already taxed in the foreign country, the U.S. government doesn't need to know about it. This is a legal myth that the 2026 rule is designed to dismantle. By lowering the thresholds and making the questions unavoidable, the government is essentially removing the excuse of ignorance. They are moving from a system that relies on you to find the rules to a system that brings the rules directly to your doorstep. The assumption is that if you are over 60 or an immigrant, you are statistically more likely to have reportable assets, and the 2026 system is built to find them. The green card vulnerability, taxes, and good moral character. For green card holders, the 2026 banking rule is not just a financial issue. It is a direct threat to their future in America. To transition from a permanent resident to a U.S. citizen, an applicant must satisfy the good moral character requirement. In the eyes of USCIS, full compliance with U.S. tax and financial laws is a primary benchmark of that character. Under the new data sharing mandate, immigration officers will have automatic access to your IRS and FinCEN history. If they find that you failed to report foreign bank accounts or misstated your international income, it can trigger immediate delays and intense questioning during your naturalization interview. In the most serious cases, consistent non-compliance or what appears to be a deliberate lie on a tax form can be used as grounds to deny a citizenship application entirely. For green card holders, the 2026 Form 1040 is essentially an immigration document. Accuracy is no longer just about avoiding a tax audit. It is about protecting your right to one day call yourself a citizen. Naturalized citizens and the $5,000 threshold. A widespread misconception among naturalized citizens is that once they take the oath of allegiance, they are exempt from immigrant-specific scrutiny. However, the 2026 regulations specifically include naturalized citizens in the high scrutiny group. The government's logic is that people born outside the U.S. are far more likely to maintain ongoing financial ties with other countries, even decades after becoming Americans. This means that as a naturalized citizen over 60 or even one under 60, you are held to the same lower $5,000 reporting threshold as green card holders. If you maintain a joint account with an aging parent back home or hold a small inheritance in a foreign bank, you cannot ignore it. The 2026 rule creates a permanent financial tag based on your place of birth. While you enjoy all the legal rights of any other American, the IRS and FinCEN will continue to view your global financial footprint through a more powerful magnifying glass than they use for native-born citizens. For naturalized Americans, full transparency regarding their international life is the only way to maintain the stability they worked so hard to achieve. Temporary residents, visa holders in the digital net. The reach of the 2026 rule extends far beyond retirees and permanent residents. It also heavily impacts those in the U.S. on work or student visas. If you meet the substantial presence test for tax purposes, as most long-term visa holders do, you are required to follow the same expanded reporting rules as everyone else. This is a critical realization for professionals on H-1B visas or international students who may still have active financial lives in their home countries. For these individuals, tax compliance is often a prerequisite for visa renewals or future adjustments to green card status. A failure to properly report foreign bank accounts or pensions under the 2026 rules can create a black mark on your record that complicates every future interaction with USCIS. In an era where data is shared in real time, your financial history becomes a permanent part of your immigration profile. If you hope to build a long-term life in the United States, you must treat your 2026 tax returns as a high-stakes component of your legal journey, ensuring that every foreign interest is fully and accurately disclosed. The financial fallout, penalties and extended audits. The 2026 enforcement regime is backed by severe financial penalties designed to act as a powerful deterrent. For FBAR violations, even an honest mistake can result in a fine of up to $10,000 per account for each year of non-compliance. If the IRS determines the failure was willful, meaning you were aware of the rule but chose to hide the account, the penalty can skyrocket to 50% of the account balance. For failures related to the new Form 8938 thresholds, the penalties are equally daunting, starting at $10,000 and reaching as high as $50,000 if the error isn't corrected after notification. Beyond the cash fines, there is the audit trap. Failing to report foreign assets can legally extend the statute of limitations, allowing the IRS to reopen and investigate your tax returns from much further back in the past than would normally be allowed. For people on fixed incomes or those with modest savings, these penalties can be financially ruinous. The 2026 system is designed to catch these errors automatically, making the risk of being discovered higher than ever before in the history of U.S. banking. Real-world lessons. The story of Maria. To understand the human cost of these rules, we look at the story of Maria, a 72-year-old immigrant who had lived in the U.S. for 30 years. Maria was a law-abiding resident who always filed her taxes but kept a small savings account in the Philippines with about $8,000 for medical emergencies for her aging mother. She never thought this tiny back-home account had anything to do with her life in America. When the 2026 rules took effect, Maria accidentally left the new mandatory questions blank because she didn't understand them. Through new data-sharing agreements, FinCEN discovered the account. Maria was hit with demands for corrected filings and penalties that initially totaled over $30,000, more than she earned in a year. Her citizenship application was put on hold, and she spent nearly $10,000 on legal fees to prove her mistake was unintentional. While she eventually became a citizen, the experience was traumatic and financially devastating. Maria's story is a warning. The 2026 system does not care how small your account is. It only cares whether you reported it. Her nightmare could have been prevented by a few minutes of organization and honesty. Action plan. The comprehensive global inventory. The most important step you can take today is to create a complete inventory of your global financial connections. Do not wait until 2027. Start organizing your records now. You must list every foreign bank account, no matter how small or inactive, and every retirement or pension fund from your country of origin. Include assets you might not think of as banking, life insurance with cash value, prepaid debit cards from foreign banks, and any partial ownership in property or businesses abroad that generate income. For each item, record the institution's name, the country, the account number, and the highest balance it reached at any point during the year. Many people get into trouble not because they were hiding money, but because they couldn't produce the paperwork when the government asked. By gathering these statements now, you are building a documentation shield that will protect you if the IRS ever flags your file for a routine review. Organization is your strongest defense against the automated scrutiny of 2026. Addressing the past, streamlined filing procedures. If you are realizing right now that you should have been filing FBARs or reporting foreign income in the past but didn't, do not panic, but do not ignore it. The absolute worst thing you can do is wait for the 2026 system to discover your past omissions. The IRS and FinCEN currently offer streamlined filing compliance procedures for people who made honest, unintentional mistakes. These programs allow you to come into compliance by filing past due reports and paying reduced penalties before the government finds the error. Voluntary correction is infinitely better and cheaper than being caught later. Once the IRS sends you a notice, you are typically no longer eligible for these reduced penalty programs. By being proactive now, you can clean up your record and move into the 2026 tax year with a secure immigration profile and a clear conscience. Remember, the goal of the 2026 rule is transparency. By coming forward now, you are showing the good moral character that the government values. Foreign income, the truth about pensions and treaties. A major area of focus for the 2026 mandatory questions involves foreign income sources, especially for seniors. Many retirees receive pensions or Social Security type payments from countries where they worked before moving to the U.S. A dangerous and common myth is that if this money was already taxed in the home country, it doesn't need to be reported to the IRS. Under U.S. law, you are required to report your worldwide income, regardless of where it came from or whether it was taxed elsewhere. While tax treaties between the U.S. and other nations may reduce or eliminate double taxation, you still must disclose the income on your return to claim those treaty benefits. The 2026 Form 1040 will have specific questions about these payments, making them impossible to ignore. If you are unsure how to handle a foreign pension, seek professional advice from a CPA or enrolled agent who understands international issues. Guessing or assuming is no longer a viable strategy in a system built for total disclosure. Conclusion: awareness as your ultimate protection. As we wrap up our analysis of the 2026 banking and tax updates, the message is clear. Knowledge and preparation are your greatest forms of protection. While these rules may sound intimidating, they are manageable for those who stay informed and organized. The government is moving toward a system where information is clearer, reporting is more consistent, and everyone follows the same rules. Your strategy for 2026 should be simple. Inventory your global assets, report all foreign income, correct any past mistakes now, and keep perfect records. If you treat your financial reporting with the same care you gave your immigration journey, you have nothing to fear. Small details are exactly what the IRS will be watching, so don't ignore a small account just because it seems unimportant. By acting now, you can navigate the 2026 tax season with confidence, knowing that your savings, your retirement, and your immigration future are fully protected. Stay informed, stay organized, and take control of your financial future today.